We also have to get a quick comment in from a global expert on what's happening in China, because that's important. China did a surprise rate cut of its key lending rates. The reverse repo is cut by 10 basis points. And this is largely because the growth recovery was losing steam. In order to support recovery, China has gone ahead and cut short-term borrowing costs. And there are now expectations of further easing from the Chinese government. To discuss more on this, we have Ben Cavender, who's the Managing Director at China Market Research Group, joining in. Ben, good morning and thanks for joining in. This rate cut wasn't expected, but going by what the government has done, the expectation is perhaps there could be more easing in the months to come. Is that your view as well? And how are you looking at the Chinese economy now?
Well, I think this was a very clear signal that the government recognizes that any kind of recovery that maybe happened through the first quarter has really kind of lost steam this quarter. And so more action needs to be taken. So this rate cut was definitely a surprise. It's probably a good step in the right direction, but I think, at least the word on the ground here is this really isn't going to do much as far as moving the needle and getting consumers to spend. And it probably also doesn't do enough to help exporters in a really meaningful way lower their prices to the extent that they're going to be able to get more business for overseas orders. So I do think we'll probably see continued action by the government over the coming months with more reserve ratio cuts. Very possibly some kind of direct stimulus to consumers, though it's a little bit unclear whether or not they're going to be doing that now or maybe waiting another quarter to see.
Ben, there is, we'll get to demand for commodities, etc., and your assessment of it in just a bit. But there is also the other angle to it, right? I mean, if you read the Financial Times, for example, they've been running a series of stories about how investors, large U.S. investors, are actively cutting exposure to China in a pretty big way. We saw what Sequoia did. I think other large funds have also done similar things. And here in India, I mean, the general chatter is that a lot of it will go to other markets, right? Like, for example, 30 years ago, there was this Asia ex-Japan kind of terminology got popularized. Now people want Asia ex-Japan ex-China. And India, of course, is a large economy which perhaps benefits. I just wanted your thoughts. Is this happening as we speak? And what's the feedback from the ground?
So I think if you look at, for example, where private equity money is going, there's definitely been a big pullback. And I think that pullback is going to continue. In having discussions with fund managers recently, I think very few are seeing a light at the end of the tunnel for China right now. They just don't want to deal with the political mess that China and the U.S. are in. So they're absolutely pulling back. I think that's going to continue for a while. If you look at the brands and how they're investing, I think a lot of brands have sort of written off 2023 as kind of a lost year. They have this understanding the consumer maybe is still quite weak and is really saving as much as possible right now. So brands are sort of refocusing to 2024. So I think there will be some kind of recovery coming in China over the next 6 months, but it's really going to be driven by multinational brands, not so much by the investment community. And as far as where that investment community is moving money, I think absolutely, yes, India is going to be a beneficiary. Probably some other Southeast Asian nations will also be beneficiaries. So I think it's a great thing for India right now. It's going to be a difficult story that China is going to have to tell to get them to come back right now.
All right. Hi, Ben. Good morning. Ben, what about, could you give us a couple of data points, say on the Chinese real estate space? Because that appears, it's in some pain out there, given the kind of action we're seeing from the central bank as well. And that has repercussions for the commodity markets as well. So your take on that?
Yeah, I think right now the real estate market is in it's a very difficult position. It's in a holding pattern. It's not going to get better anytime soon. We've had multiple discussions with senior executives at major Chinese developers. So if you talk about Wanda, if you talk about Shimao, who's some of the better developers in China, they're under a tremendous amount of pressure right now with a lot of unsold property, still carrying very significant debt burden. So I think that's an issue. I think also what we're seeing right now, which is probably more problematic over the long term for China, is the local governments have really seen real estate sales essentially go to zero, and that's has huge implications for their tax base right now, and it's a very difficult situation to get out of.
Okay, so what are you factoring in terms of the growth in China? What are we looking at, say, by the end of FY24? I think there is an expectation that it could be, to the tune of about 5 to 6 odd %. And it may not surpass what we've seen in the past, but your own projections?
Yeah, for many, many years, I've been quite bullish on China. I tend to be quite positive about China overall as far as their economic planning and what happens here. I think this year, counter to that, I would say it's highly unlikely in my mind that they're going to hit that 5% target that they've talked about. Probably we're going to come in somewhere closer to 4%. I just don't see positive signs coming from the consumer or from factory orders right now that would suggest that China is going to have the kind of recovery that maybe the government would like to have this year.
Ben, sort of just to go back to the larger impulse right now, which is, U.S. Companies in that sense, but large investors moving away. You think it's going to go continuously in one direction, or you think the government in China will do, will change course at some point? Do you think it's inevitable that there is a break and that, the gulf gets wider and wider? What's your sense?
I think at some point we'll have a turnaround. I think the reality is that there's no possible way to do certainly a complete decoupling between China and the U.S. The economies are still too integrated. I think a lot of U.S.-based funds and U.S. companies still would like to have a strong presence here. They just don't see now as the right time. And I think the government as well realizes that, they can push their own agenda as far as sort of rebalancing international trade, rebalancing reliance on the dollar, maybe more towards the renminbi, but they can only do so much. And so as the economy stays slow here, I do think we'll actually probably see a little bit of a recoupling and hopefully things opening up and flowing back in this direction again. I just think it might take 6 months before that starts to happen.
All right. Thanks a lot for joining in, Ben, and appreciate your thoughts on the Chinese market. But let's get